Hi, Vera Mays here from the Learning Commons. Today our topic is marginal taxes, exemptions, and how much you have to pay to the IRS. I really like the fact that you guys are studying this topic because I think it's important for you as a consumer to understand how the tax system is set up. Even though most of us will plug it into a machine probably or have somebody do it for us, at least you're a little bit more aware of what's going on behind the scenes and how it's all calculated. So today we're going to talk about using the marginal tax tables and then putting your deductions in. So I have an example for you, and if we have anybody log in from home and you have questions, let me know. All right, so this is the table that you get when you do most of your homework problems, and it's in the book, and you have to first decide for each example which column are you going to use. Are you unmarried, divorced, or separated? Are you married, filing separate tax returns for some reason? Are you married, you file one single tax return? Are you unmarried and paying more than half the cost of supporting a child or a parent? So in my example, let's go ahead and do some terms. So your gross income is everything that comes in terms of positives, like your salary, your wages, your tips. If you have interest in a savings account, or if you go over to the golf and you win lots of money at the casino, you have to claim that prize money. So your adjusted gross income takes that dollar amount and it takes off any adjustments that you have if you've made contributions to an IRA, some kind of health savings account, a tax sheltered annuity. So then really you're only going to be looking at your adjusted gross income minus any deductions and then minus any exemptions that you have. So I have a nice example for us to look at. We have a nice couple, Walt and his wife, and he earned $52,000, she earned $48,000. They received $600 in interest. They have two lovely children, and their itemized deductions were $84.30. And they do have a tax credit of $1,000. So going back to our table, because they're married and they're going to file jointly, we are going to be using this category. So everything we do is going to be looking at our income, our taxable income. After we calculate that in a minute, we're going to compare it to this category and use all of the columns here. All right, so here we go. Their gross income with all their interest income and what they each made was $100,600. They had taxable income then. If you take that amount and you subtract the standard deduction, which is, let me go back to the table. The standard deduction is here on the bottom of the table. Each person they get to deduct $3,500 for. Let's go back. So they have 4 people in the family. So 4 times $3,500 gives them a taxable income of $75,700. So now we have to go do a little bit of math work. We're looking at the table. Again, we're going to use this column right here because they're going to be married filing jointly. And our amount, let me go back and get the amount, $75,700. So keep that in mind. Sorry, my pen's not working today. $75,700. And if you notice the table, if you only make up to $16,050, you only have to pay 10% of your income as tax. But Walt makes a little bit more than that with his wife, so we're going to have to look at several different columns until we get up to the column that maxes out with $75,700. So what we have to do in each case, I have a little table ready for us. All right, so the first $16,050, he's only going to pay 10%. So one of the best ways I found to do this is set myself up a table with 4 different columns. The first amount, we're going to pay $16,050 at 10%. Remember, you are always converting to a decimal, and then you multiply. The difference times the percent gave us 1,605. We got to keep going because he made their taxable income was more than $16,000. So I look at the next category and it says it works up to $65,100. So we take the $65,100 and we subtract the upper limit of the group before it. This is at 15%. Change that back to a 0.15. Multiply, and we get this amount that we have to add to our tax total. Now he's still not up to the 65,000. Is still not up to 75,000. So we have to go to the next category. This category would actually work up to 131,450, but he didn't make that much for his taxable income. So we have to take his maximum income minus the boundary for the group before, and that leaves us with 10,600. Change it to a decimal and multiply. And it gives us another amount that we have to add to his tax bill. To get the total taxes that they have to pay, you add all those amounts and you end up with $11,612.50. So each amount that you make gets taxed at a different percent. If you don't make up above $16,000 for your taxable income, you only pay 10%, and every group goes up from there. All right, so how much tax does he owe? He had gross income of $100,600, taxable income with all the deductions and everything subtracted of $75,700. So in this case, this poor family owes $11,612.50. But they had a tax credit. So at this point, we now get to subtract that tax credit so that we now owe only $10,612.50 to good old Uncle Sam. All right, so this is a brief glimpse at using the marginal tax tables. If you have more questions, come on in, we'll help you. You can also use the online tutors at Smart Thinking, but we're here to help you. So come on in, I hope this was beneficial.